Welcome to Stock Talk with Nico Criticos. Today we're going to be going through the stock Upstart, and I'm going to be taking you through some analysis on if I think it's a good buy or if it's not a good buy. So first off, this video is dedicated to Kevin George, who asked me to make this. And what Upstart does is they are a company, they are pretty much a middleman between banks and borrowers, people looking to take out a loan. And the way they do this is through artificial intelligence, and not only using credit scores, but also using over 1,000 other factors. They come up with a more accurate way to give people loans and lower their interest rate while having a significant more amount of borrowers that banks can accept. So we're going to start by looking at a little bit more in detail of what they do and how they do it. So as you can see here, how I just said, they are a leading AI lending platform, and they pretty much connect consumers to AI-enabled bank partners. And they're aiming to have more of their business in small to mid-sized banks. They're not partnering with huge banks, just the smaller ones. And 60% of the loans are instantly improved and done fully automated. And then most of their revenue, about 92%, is coming from the fees that they charge these banks to use their AI software. So some things they use are employment history, credit experience, the person's education, their cost of living, bank transactions, and application interactions. So then the next thing we can look at is Nico Stock Market Checklist. And so the reason why this company is so interesting is because it looks like they can give a better representation to the banks of the true risk and the trustworthiness of these potential borrowers. And since they're using artificial intelligence, it makes it more automated, more profitable, more efficient, and easier to scale on a big scale. So the more data also that they collect from customers, then the more accurate their system is going to be, and that's going to help it. That's going to help it even more. So it's a really like a positive compounding effect over time. And the goal here is to have higher approval rates and lower interest rates. I think it said 27% more borrowers they're going to be able to bring on, and then I think it's 16% less in the interest rates charged. So previously, 2 years ago or so, I'm not sure if this is before the pandemic or after, but 130 million Americans roughly have taken out a loan, a personal loan, and Upstart says that their software is able to approve roughly 27% more people, making it about 165 million Americans. And the average loan that these Americans take out is about $10,000. So that means that total addressable market is about $1.6 trillion. Okay. So if Upstart, let's say in the future, 5 years from now, can get just 10% market share. So an Upstart they're not giving out the loan. They're not the one lending the money. So that does take some risk off of them. That's not a risk they have to deal with if people don't pay back the loan. That's still on the bank in that situation. But what they are doing is, if they can serve as the middleman and connect that bank with the borrower, then out of that $1.6 trillion TAM, and just put together 10% of those sales, 10% market share is not anything crazy, then that would be $160 billion of revenue. Or no, that's $160 billion of market share, but that's going to be like the amount of loans that are going to be transferred, but they're getting 8% of that loan amount. So it would be $13 billion of revenue. So to me, that seems extremely attainable. That is a very conservative estimate, and I think it could even be much higher than that in the future. How I said earlier, they use over 1,000 different variables that factor into the approval process, and so that's part of why they are so much more efficient in how they approve people. As far as the dangers go for this stock, number one is going to be that 63% of revenue in 2020. So keep in mind, this is over a year ago. The 63% of their revenue was coming from fees from Cross River Bank. And in 2019, that bank accounted for 80% of their revenue. So both of those, both of those are bad, but the thing to look out here for is the fact that it's coming down, because we do not want any business that has 63% of their revenue coming from one customer. That is not good. That is not good at all. So, but I think since it was 80% the year prior and then it went to 63%, I'm really hoping when they report earnings in a couple of weeks now that that number is even half of that. I'm hoping it's, anywhere around 30% or less if possible. But that's one thing to look out for that is very important. Number two is the fact that we're going to have, probably at least 3 rate hikes coming this year. And they even talk about it in their 10K where they say when interest rates are going to be higher, that is going to hurt their business, and that is going to have less people are going to be able to afford loans, and that's just the way it works. Then number 3 is going to be their share increases. If we look at, let's go right here. If we look at the number of shares over the past year, you can see here that it has gone up over 400%. So that is always not a good thing. See, 440% more shares on the market now. So that's a huge dilution for this company. But yeah, I don't know. Maybe they needed to raise. They did acquire a new company recently that is going to allow them to participate in the auto loan market. And so that's a much bigger TAM. If we look here, you can see the TAM for that is $672 billion. And the personal loan market is only 81 billion. So now that they're in this auto loan thing, that opens up a huge TAM for them, as well as it looks like they have plans to also get into the mortgage loan business, and that's $4.5 trillion. That's why the TAM and the opportunity for this company is just insane. This could be a company that 10x's their revenue in the next couple of years. Then if we keep going, we can see, so using my checklist, here we have, is the stock down or oversold? Yes, this is a stock that this time last year, it was trading around $64, and it managed to get all the way up to $400 in October. Now it's come down a lot. In the last couple of months, it's down over 70%, and it's down to much more healthier levels. So we're going to give that a yes. As far as net income and revenue, you can see right here that I think revenue was up over 200% this year, which is incredible. Revenue growth of 245% this year. A year ago, they did $230 million of revenue. This year, they're going to do $800 million. And the next year, they're expected to do $1.2 billion. So that's 49% revenue growth next year. And this is a profitable company. That's very hard to find a company growing this fast. That's an innovative company like this, and there's still the profit margins are there. So I was really surprised by that. Next up, we have how does their price to sales and price to earnings metrics look? And they don't have a price to earnings. Well, they do have a price, a trailing, but they don't have a forward. So of course, the price to earnings is high, and the price to sales is high. But it was 54 at its highs, and then it was about a year ago, it was a decent amount lower. It was 13 and 9. So I would like to see it come back down to maybe like a 15 or something. But it's definitely, for the amount of growth they have, a price to sales of 21 for a company that's growing 245% this year and 49% next year, that is not bad. There's a lot of other companies priced much richer than that. So that is, I would like to see it come down a little bit. I'd be much more eager to buy it if it did fall another, 15, 20% and have that price to sales come down, but it is not too overvalued at these prices. Next up, is a company innovative? Do they have a moat? I put yes. I mean, how many companies are doing this? You have other companies like Lending Tree, which are also, I haven't really researched that company much yet, but I plan to in the future. And I mean, there's not many companies doing this with this AI software type of thing where they're connecting the banks and the borrowers. And the other thing too, like similar to Tesla, that's what comes to mind when I think of this, is companies that use AI and data at the core of their business model. That is a moat in itself, because when the success of your business model and your moat is dependent on how much data you have and the quality of your data, that is not an easy thing to replicate. So like in Tesla's case, they have like 100 times more data than any other company. I think Google's in second place. Then they have 100 times more data in self-driving and autopilot miles, because they have so many more Teslas on the road. You know, they have 1 million more cars on the road, and they're more popular. And so something like this is kind of similar, where if they can you know, be at the frontier of this change in the industry, and they can get a bunch of deals and get stuff going before other companies can move in and copy them, then they're going to have so much data that's a hard thing to replicate. So, and this is absolutely an innovative company, no doubt about it. So that's going to get a yes. Industry is definitely growing. Personal loan, I think it said personal loan industry is the fastest growing, but of course it's not the largest as far as TAM goes, because the auto market and the mortgage business is so much more bigger. But I think personal loan is the fastest growing. So that's but yeah, and they're expanding. They mentioned like 6 or 7 different loan businesses they can get in, like student loans, personal loans, all these different types of loans. So the TAM for this company is literally they're dealing in a market that can be trillions and trillions of dollars, 5-7 trillion dollars worth of TAM. And if they can just get a tiny little fraction and get a couple % market share, that's going to be billions and billions and billions of dollars that they could be making. So super interesting opportunity. Return on invested capital. This is another thing that surprised me. If you look at their return on invested capital, it's actually positive. This is something, again, I was imagining it was going to be negative, but it wasn't. So let's see, return on invested capital, 17%. That's super good for a company growing this fast too. That's not easy to find. Healthy margins. I believe their profit margins for the trailing 12 months was 13%, not bad. I also read an article that based off of the fees they take from the loans is roughly an 8% margin. So that's why you're going to see, I gave you some analysis at the top with that 8% profit margin. I also have another one at the bottom with some different numbers. And that's where I got that from. So I read that article that said 8%, and their profit margins, though, their EBITDA margin is, I think their EBITDA margin is like 16%, but their profit, for the last year, their revenue and net income was 13% of revenue. So, and normally things become more profitable as you scale up. So this could be a company that has like 25 maybe a 20% profit margin, and they could be doing billions and billions of dollars in profit if they can just become a little bit successful at what they're doing. So pretty interesting. Diverse revenue streams, I put no. Okay, I put no, but of course, if they can expand into 6 different types of loans, then that's going to turn into a yes. They don't break on the balance sheet. Wait, where? Yeah, they don't break down long-term and current assets and liabilities. So, but they do have more assets and liabilities. So I did give it a yes. And then equity is increasing, and so that's going to get a yes too. So balance sheet looks good, growing pretty fast. This is their net margin. See, here we can see 12%. So you can see net margin has been growing in the last 2 years. It's gone from negative to 12% now. So that's their net income margin. Let's see, can we see? Yeah, that's the main one there. Then we have the final 2 are going to be a share buyback or dividend. No, as you saw, share increases were crazy. And then big money interested, yes. Not only do you have hedge funds buying into this one, but you have, last month, there was 5 insiders who bought into this company. So that's pretty interesting. That's a good sign. And then finally, we have, so as you can see here, it says 75% fewer defaults at the same approval rate and 5 times more predictive than credit score. So pretty interesting stuff there. Then we have, so see, it says charge fees at roughly an 8% of total loans it generates. And of course, these numbers are from the slide I just showed you. And so if Upstart can put together 10% of those loans and maintain their service fee margins of 8%, that's $6 billion of revenue for the year. If you add mortgage loans, that's $42 billion of revenue. So I think this could easily be a company that's worth $200 or $300 billion 5 to 7 years from now. So I'm going to keep an eye on this. I'm very interested in seeing what they report for earnings and listening to the earnings call when this comes out on, let's see, what day, February 15th. And so if this one comes out a little bit lower, if this was like $80, I would be very interested in buying this. At 111, it's not bad. If you're looking at the long term, it's not bad because I think this could be a $400 or $500 stock in a couple of years. But we'll see. Well, I'm going to keep an eye on it, and maybe I'll make a small position. But yeah, if you guys let me know what you guys think down below. Comment down below. Tell me if you're buying this. Do you think this is a cool company? Do you think it's gonna fail? What do you think? Let me know.